Okay. Well, look, I've done this for a long, long time. I've seen it all, but things have changed. What is happening today is not what I know. It's not normal. But most people who have gotten into trading during the pandemic, because they were sitting at home, and thanks to Robinhood, which democratized trading for everyone, retail got a lot stronger, and retail is moving markets now, right? We used to have a saying about retail when I was on the desk. It was dumb money. In those days, definitely dumb money. Today, I think the institutions are dumb money because they can't even outperform the benchmarks. How many hedge funds outperform the benchmarks? 2%. How many mutual funds outperform the benchmarks? There's close to 5,000 mutual funds out there. These are all pros, MBAs, Wharton graduates, best computers, best analysts. They can't beat the benchmark. Forget about anything else. So the dumb money now is the institutional money. They just go follow sheep, like go here, go there. So retail definitely has power. But for me, the important thing is, buying every dip is fine. It worked for the last 3 years. But most of you who are trading today or who are involved in markets have zero recollection of history or zero idea about history. Look, history is important. You got to know. Just like you root for a team, you know their history, they're all stars from 15, 20 years ago, if you're a true fan. I'm a true fan of market history, besides being a trader. Well, we know what has happened. Now, are the circumstances the same for that to happen again? When I'm talking 2000 dot-com bubble, there are a lot of similarities of what's going on today with the 2000 dot-com bubble, such as the AI circle jerk. It's like OpenAI invests in Oracle, Oracle invests in NVIDIA invests in AMD or Intel, and the circle jerk. The same 100 billion, 200, 500 billion dollars is going around. That's the same story as, Goldman Sachs gives B of A $10, B of A stock goes up. B of A gives JP Morgan $10, JP Morgan stock goes up. It's the same $10. The JP Morgan goes around, gives Wells Fargo $10, Wells Fargo stock goes up. And then Wells Fargo turns around, gives it back to Goldman. It's back to where it started. Goldman goes up. Hey, that's what's happening in AI. Where is the ROI on this? Is the ROI, ROC going to be there with all the spend? I mean, these people are spending hundreds of billions of dollars. Okay. And then, when AI sure comes around and AGI comes around, what's the effect on the society? Okay, we need to start thinking about these things. You can't trade zero DTEs thinking like that, but I do think about it, and there are a lot of similarities between dot-com bubble and today, and there are a lot of similarities between what happened to WorldCom and Enron and things like that, with the circle jerk going around. Again, I'm not saying any of this is happening. All I'm saying is you just study history. Then you have history again in 2008, GFC. Is it there? No, of course not. Banks are in much better shape than they were before. But no, understand history that sometimes things do get out of control. Sometimes system breaks. Sometimes there are some weak players in the system that need to get flushed out. And when that happens, due to so much leverage in the system globally, we have $330 trillion of debt sloshing around the globe today. Okay? Again, you can't trade zero DTs understanding this, but at least understand it. And always be cautious, right? Always be cognizant of the fact that things have happened in the past, and one time this 3% pullback or 2% pullback is not going to be a viable dip, just because it has been for the last 2.5, 3 years. Again, people's attitude are they have not seen anything more than that in the past, maybe 5% pullback. I mean, what happened in April is a good point, right? Everybody thought, yeah, I'll buy the dip. Well, if you bought the dip, you got smashed. Now, the V bottom happened, and then market came back and saved your ass and gave you more. But that's also not normal. Folks, what's happening today to stocks when they move, and we're talking hundreds of billions of dollars worth of companies moving 50, 60 points or 2, 3, $400 billion in market cap every day, that is not normal. I can assure you that's not normal. What's happening with these overvalued quantum stocks, that's not normal. What's happening with these power generation stocks, because AI is going to need all the power, like Oklo and IREN and all these other companies. Stocks don't move like that. Now, what are we pricing these stocks for, especially if they don't even have a dollar's worth of revenue? Forget earnings. What are we? Because at some point, fundamentals will take over. Momentum is something that we trade, and it's very powerful, and you can't argue with momentum. I mean, momentum is there, but the momentum, when it ends, nobody knows when it ends, and it ends out of the blue like that, and then now you're holding the bag. And to me, that's when you're going to be in trouble, thinking, yes, it will come back, yes, this was the Bible dip or whatever. But for the last 3 years, right, dip has been bought. What happened from 2021 all the way to the end of 2022, when Fed was going into an interest rate hiking cycle? Not too good, right? Not too good. So there are grinding markets, bear markets down, but worst comes to worst, bear markets on average last about 18 months. We're not even close to a bear market. We were just making an all-time high yesterday. So the point is, be careful, manage risk properly, set a goal, and you'll be fine. Keep your drawdowns to a minimum, because not every time the market's going to put in a V bottom and come back and save you. Okay. In April, I'm pretty sure most of your accounts went down 40, 50, 60%. Yes, the market came back and saved you. But how about this? How about during the drawdown, you kept it only maybe 10, 12, 15% max? Because to come back to even from 15%, all you have to do is go get up 22%. But to come back from a 50% drawdown, you have to double your account just to be back to where you were. So it's simple math. I pay attention to these things at this stage of my career, in my life, in my financial situation. I don't need the excitement. I have a goal in mind. Hopefully, I'll attain it at the end of the year. I want to obviously beat the benchmark by probably 5x. And if I can do that after taxes and slippage and commissions, I'll be fine. But everybody should have some sort of an idea of history, like what has happened in the past. Again, not saying it's going to happen again, but history does repeat, because for all of you who draw chopsticks or technical analysis, I am as good a chart reader as anyone I know. And sometimes things don't hold where they're supposed to hold. And my biggest concern is people do not know what could happen. Now, does that stop me from buying in Rigetti at 5 and selling it at 45? Or, yeah, of course. Does that stop me from doing it? It's not paralysis through analysis. It's common sense, because I've seen this movie a million times in the last 30 plus years, right? Somebody has to hold the bag on these, because a company that has no revenue, and there are many of these out there, many that are getting priced for beyond perfection now, right? Okay. What happens in our markets is stocks move first. The price moves first, and then earnings catch up. Well, what earnings? We don't even have revenue. Forget about earnings. Earnings will come. But what will happen is stock will move, and people will go like, why is the stock moving? I'm like, nobody understands. But the market is that. The whoosh will come, stock will move. And then it will consolidate for 6 months. And then earnings will catch up. The next quarter will show up. Earnings will be announced. Stock will move higher. And then earnings will catch up. But right now, the stocks are moving in this level, parabolic, for companies who forget earnings. They don't have revenue. I can't even put a price to sales multiple on these stocks. Forget about price to earnings and all that old stuff that we used to follow, right? And again, fundamentals do make a difference. But then I'd use both. I think about fundamentals, macro, and I call myself a techno-fundamentalist. I can read charts as well as anyone on the internet. But then I watch charts, they tell me the past, they don't tell me the future. Yes, patterns sometimes are repeating, I get that. But I watch naked charts. I don't draw lines, because all that does is create bias for yourself. That's when the trouble shows up. On a day like today, that's when trouble shows up. On a day like today, if you're day trading, you could have drawn lines 50 times over. You have adjusted your lines 50 times already. But again and again, all I'm saying is, watch your drawdowns, keep them to a minimum, and, so that on the comeback, your account could get to an all-time high. That's all you have to do. Just watch. Watch your account equity. That's what I trade. I have like 10, 15 positions in the account. Puts, calls, stocks, this, that. They're all doing something, and they're all getting mark to market every single second of the day. But that's all reflected on the upper left-hand corner on Thinkorswim, where your account equity is. If you had $10 yesterday and you have $11 today, you're up 10%. At the end of the day, that number is going to be green or red. Very, very infrequently, it'll be unchanged, which is impossible. I have a six-figure account. It's always red or green. Well, when it's green, that means overall, the positions that I've set up for myself are helping my account equity. But that's what I watch. I don't watch each individual stuff, although I do watch each individual stuff with the risk parameters that I've set, because when they get there, or taking profits or taking losses, when they get there, I'll do it. But all of it, every second of the day, is reflected in account equity. And that's what I'm trying to teach my members all the time. You got to trade account equity. Don't worry about this individual position. Size correctly, allocate correctly, and trade your account equity. If you're doing the right things, account equity should make all-time high after all-time high. And the drawdown should be minimum.